Okay, hello everyone, and welcome to this second part of the introduction to the price ladder. In this second module, we're going to be going through various price ladder order and execution types. Um, and in that, we're going to see just a few that I think are quite important. Obviously, there are plethora of different order types you can put into the market. Some of these you'll be able to use on your Futex live trading platform. Some you won't yet. But in any case, it's important to know them, to be aware of them because they are taking place in the marketplace at all times and every single day. So if we just take a look, first and foremost, um, what we're going to be going through today is obviously, like we said, price ladder order and execution types. And the very first order I want to go through, and we'll kind of just roll through this in alphabetical order, is the best limit. Or you sometimes see it a BL. Now, the best limit is basically an order whereby if you click best limit, your order joins the best bid or offer without the requirement of a price being entered. So the order joins best bid slash offer without requirement of price being entered. That is your best limit order. Obviously, an order type, if the market, for example, I don't use this order type, but for example, if the market's quite volatile, you don't really want to be using a best limit order, but it's something possibly that algorithmic trading sort of systems might be using. Move over to the next type of order. We have the block order type. Now, a block, you don't necessarily see this interaction. You see it on the price. You see it on the price ladder. You see it sometimes on your, let's say, your delta footprint. But it's a high volume trade. So it's a high volume trade whose price has been negotiated. It's been negotiated by two parties. And that's outside of normal exchange traded methods. Exchange traded methods. Now, what usually happens with this is, let's say a big bank with another bank, they agree to trade at a certain price. They say, okay, we want to trade, let's say if we're looking at the Euro FX, for example, we want to trade at on spot 1387. So when the price gets to that area, they'll block trade, and a trade of, let's say, 800 or 500 will go through the market, maybe even 2,000 lots go through the market. It's usually a very high volume trade, and it happens just in one block. It doesn't take place in increments. There's no slicing of the orders or anything like that. Really, when these block orders go through, it's an agreed at one price, agreed this much volume, and the whole volume goes through in one big block. So that's essentially why they call it a block. Likewise, if we take a look at a cross, again, it's a prearranged trade. So prearranged trade with either a party within the trading firm, or a specified party outside of the firm. So it's basically a prearranged trade. You cross the trade, it can be within the firm or it can be outside of the firm. So within or outside firm. Prearranged trade though, something obviously to keep in mind. Likewise, like the block trade, it's a prearranged trade. Then we have an interesting order type called the fill or kill. And put that in brackets, F-O-K, fork. Yeah. So the fill or kill is, let's say, an entire order either gets filled immediately or that order is immediately canceled. So basically, in essence, that's basically what the order type is. If an order gets put into the marketplace, let's just say someone puts in, 300 lots here at 113.81 at this price here, and he keeps it on there for, let's say, 2 to 3 seconds, or let's say he puts in a barrier of 3 seconds. If that's not filled within, that would have been filled now. But obviously, if that hasn't been filled within 2 seconds or 3 seconds, whatever he puts that time variable as, if that's not filled immediately, it gets canceled and he gets pulled out of the market. Not something particularly any intraday traders tend to do. It's probably more an institutional, again, a more institutional type order type. If you don't get that price, then you don't want to get the whole order done. You don't want to get a partial fill. In the case that you get, let's say, a partial fill of 10 out of the 300 you've put there, and then it starts bidding up, it starts running away from you. It's either you get the whole lot or you don't want it at all. That's basically what the fill or kill does. So fill or kill, as we said, entire order fills or it's immediately canceled. That's an interesting type of order type. And the next one we're going to look at is the good till canceled. And that is a GTC order. GTC orders usually, at least within the intraday trading business, we don't usually use these as often because we're usually coming in and out of the market flat. So we come into the market flat, we leave the market flat. But the GTC orders is a good till cancel. Is the order works. So the order works on the book. So if you put in an order anywhere, let's just say, for example, I put in a GTC order at 11,388 at that price right there, as you can see. That order on a good till cancel will stay there either until it's filled, you cancel it, or the contract expires. So it's just basically there, the whole time while the contract's open. So it's either it works until filled, canceled, or contract expires. That's basically the good till cancel. Usually what you find with these orders, it's an order type that sort of longer term traders use. They want to get filled. They put in a limit order at a certain price that's away from market. They don't want it to get canceled overnight. They put it in there. Or if you got an overnight position, longer term traders, or if you have overnight stops, you want to put an overnight stop just in case it gets to a level. Let's say if you're short the market, and you want to put in a stop loss order, a buy stop loss order somewhere just in case it moves heavily overnight. You want to make sure you're out the next day. So it's just the safety of getting filled or the safety of getting out, basically. Now the next order type, an interesting order type that I think will go in a lot more depth in some of the later modules, is an iceberg. Now an iceberg order, very interesting order type. You basically get larger orders and they're split into smaller disclosed orders. And when the disclosed portion fills, the next disclosed order quantity enters the market until the total goal quantity is filled. So essentially, it's an order that is placed in the market. So for example, if I wanted to sell a load of contracts at 113.85 here, but I didn't want to show my hand. I didn't want to say, okay, I'm good for I'm good to sell 1,000 contracts here. If someone just appeared on a relatively compared to 1,000 lots, quite thin order book here. If I put 1,000 lots on the offer, the market will probably start running away from me. And you don't want to show the market your hand. So what you might do is uh, you know, split your order into 10 orders of 100. So you've got 100 lots that appear on the offer. Once those 100 lots are filled here, another 100 lots appears. So it gets refreshed. So what you see here is that the offer is refreshed, either refreshed or sometimes we call it um, reloads. So refresh or reloads. So that order gets refreshed or reloads, and that's a really, really important order to understand, especially if you're trying to understand the price dynamics and price ladder. And you see that an order keeps on refreshing over and over again. There might be a bigger buyer or seller than what is actually being indicated on the book. So iceberg orders are essentially um, orders. Let's 1 second. Make sure we get this right. It's not just an order. It's a large orders that are split and refresh at price, as I just explained. Now, the next order type, quite an important, very simple order type, is the limit order. Now, I know this is quite long, and I don't want to bore you guys with all these order types, but it is really quite important to pay attention to these, because later on, when we start talking about certain price setups and certain price action dynamics, and we talk about these order types, I want you all to be very, very in tune with what I'm saying and not have to, go back and review these or look online for them. I'm just going to give you all of them right now so you understand what they mean. And when we talk about them a little bit more quick, we don't have to, make pit stops and explain these on the way. So a limit order is either a buy order, basically specifying the maximum price you're willing to pay, or the sell order, specifying the minimum sale price you are willing to accept. So a limit order is basically an order like we just put in before. Let's say I've got my five lot clip. I place in a limit order at 11381 or 11393. Let's say. Now these are limit orders. The market's gonna have to move towards me to get filled. It's basically the maximum price I'm willing to pay for my longs and the minimum price I'm willing to pay or not pay except for my shorts. And that's basically what these limit orders actually depict. So I'll just cancel those for you guys here. Quickly right over here. Max price for longs. Min price for shorts. Now, next order is a very important order. Like we were saying before, in very volatile times, you have to be aware of the market order, or any time really. If you're trying to be aggressive, you're going to use the market order. The market order is basically, got a clip here. A market order is if I just click at market right there, that's a market order. I've just executed at market. Likewise, I can execute again at market to get out. Just below there, that's a market order. Um, um, So basically the market order is an order that hits the best bid slash lifts best offer. It's basically a market order. Then we've got a very interesting order, something that a lot of the FTX traders look at every single day. So important to know the market on close, or the MOC. MOCs, market on close orders. It's hugely important. Every day into the close, there's a lot of volume that comes into the market. And having said that, I mean, maybe it's just some sort of prearranged occurrence over the years where all market participants know that towards the end of the day, there's large volume coming into the market, and as you know, consequentially, a lot of the institutions like to take care of their orders during that time because they know there's lots of volume. So they'll put MOC orders, and there's a lot of, like I said, a lot of volume, sometimes quite a bit of volatility into the close because of these orders. So, like we just said, these are market orders, not limits. They're market orders that are sent during the closing auction. Closing auction of current business day. And you can obviously, you can basically put these MOC orders at any period of the day. They can be entered at any time during the day. So it doesn't necessarily have to be put in at, at the close. You can just say this is a market on close order at the closing auction. Let's say within the last 5 to 10 minutes or 2 to 5 minutes, those orders are going to go through. Then we've got, likewise, very similar order, the market on open. So the MOO. So the MOO orders, also quite important. Opening orders, sometimes the market opens and we see a good amount of volume. People want to get in and out of positions. For example, if we've got a large fundamental event that has changed the fundamental landscape, let's say trying to cut rates, or for whatever reason, something's changed overnight. Let's say a market that's been closed opens up, it needs to reprice, people put their market on open orders, and they get executed. So these are market orders sent during pre-opening period. And they're intended for execution at the opening market price. So at that opening market price, they execute at that price. That is a MOO, market on open order. Then we've got an order cancels order. I'll just put that bracket in here, OCO. Now the OCO are basically, they're two orders for the same quantity and contract at different price levels. When one of the orders executes, the other is canceled. So let me give you an example. So for example, if I was long the market here, as you can see there, I want to get out at this price here at 11,400 the figure, and I'm going to put in a stop loss order, let's say 4 ticks below. So basically, if this was my setup, I was long, as you can see here, long here, wanted to get out of the trade here, and I either get out of the trade with a loss here, so this is my stop loss order, or my limit order here is where I'd like to get out of the trade for a profit. Now with an OCO, if I connect these two together, and we don't currently have this functionality yet on the Futex live trading platform, but it will come up very soon, and it's very simple to do. You just basically connect these such that um, if one of these gets hit, so if let's say my stop loss order gets hit, my limit gets canceled, or if my limit gets hit, then my stop loss order gets canceled. So I usually use these orders if I'm in the market. I go out for lunch for a quick, 15-20 minutes to pick up some lunch, just in case something happens in the market and my either my stop gets hit. I don't just want to have an order in the market that leaves me vulnerable. If my stop gets hit, I don't want to leave myself vulnerable here. Or if my limit gets hit here, I don't want to be vulnerable with a stop in the market down here. I don't necessarily want to be short the market. I just want to get out and get flat. So those OCOs they do make a difference, and they do help if, let's say, you're leaving the office, for example. That's a very good example, I'd say, and where most people tend to use these order types. Let's just get out of the market there. Right. Let's just quickly put that in a little description. So 2 orders, same quantity / contract at different price levels. One executes, other cancels. Then we've got, just before the last one, we've got our stop limit. So basically, that's an order that triggers when the market has reached or penetrated a specific price in the market. Stop triggers are typically set worse than the current market, and once they're triggered, a limit order is entered in the market. So it's the difference. I'm just going to put down the next one because it's stop limit and stop market order. So the stop limit, when it reaches a certain area or price, when it basically reaches that specific price, a limit is entered into the market. So when specific price penetrated or reached, stop order entered in the market. However, that is a limit order. Stop market is pretty much the same thing. That order gets triggered when the market has reached or penetrated a specific price, but once it's triggered, a market order is sent to the market. So this is exactly the same thing as above, except when it gets triggered, there is a market order, not limit. I think that's pretty self-explanatory. So that was a little bit of a longer video than we usually do. We've covered the majority, I think, of the order types that I wanted to cover. It's a little bit messy. Hopefully you did get the gist of what I wanted to go through. The most important thing is understanding what each one of them means, such that when we move forward, we can smoothly progress through it without, like I said, making any pit stops and kind of filling in any sort of gaps. So please, if you guys do have a minute, maybe go through this video again if you have time. Make sure you understand these concepts. We will be revisiting a lot of these order types as we trade on the price ladder and build our skill set in trading price action. Thank you, and stay tuned for your next video where I'll be going through order book and trading terms. Well, basically lingos. Trading lingo that's really quite important for a trading arsenal.